In December 2008, amidst the global economy sinking into the sea of fire of the financial crisis, a real bomb was dropped right in the middle of Wall Street. That bomb was named Bernie Madoff. Standing before his two sons, he calmly confessed a horrifying truth. It's all one big lie. In that very moment, $65 billion officially evaporated. Not a single actual trade had ever been executed. This is not just the greatest fraud in history, but also a chilling tale of how one man manipulated psychology, deceived mathematics, and bypassed the entire global regulatory system. The story begins in the 1960s. With a mere capital of $5,000, Madoff painstakingly built a completely legitimate and highly successful stock brokerage business on the upper floor, serving as the perfect smokescreen for a massive, money-devouring fraud machine operating on the lower floor. To achieve this, Madoff did not use cheap, empty promises. Instead, he executed an institutional brainwashing art using the halo effect. Madoff turned himself into a living legend, a pioneer in electronic trading, and a three-time honorable chairman of the Nasdaq Stock Exchange. For investors and regulatory agencies, this powerful title was an absolute risk-mitigating shield. Their mindset was deceived by a systemic logical fallacy. How could a chief architect of the modern financial market despicably run a Ponzi scheme from his basement? Capitalizing on that halo, Madoff transformed his fund into an exclusive private investment club. Unlike ordinary scammers, he never went out to solicit clients. Conversely, people had to cry and beg for him to accept their money. From a behavioral psychology perspective, Madoff brilliantly executed the artificial scarcity tactic. By frequently and nonchalantly refusing capital under the pretext that the fund was oversubscribed, he struck directly at the pride of the ultra-rich, triggering a fear of missing out, or FOMO, that made them blindly surrender their money and voluntarily bypass all rigorous due diligence procedures. Even more terrifying and ruthless, he fully exploited the affinity fraud model by targeting his own Jewish community. At the luxurious Palm Beach Country Club in Florida, Madoff played the role of a generous philanthropist, causing numerous intellectuals and great organizations to fall into his trap due to the naive belief that family would not deceive each other. The charitable foundation of Nobel laureate Elie Wiesel saw $15.2 million evaporate, while Yeshiva University suffered a massive loss of up to $110 million. To convince the most sophisticated minds on Wall Street without arousing any suspicion, Madoff created a mathematical black box called the split strike conversion. On the surface, he touted this as an absolutely safe strategy, buying blue-chip stocks combined with trading options to halt any market downturn. But when viewed through a quantitative expert's eyes, this illusion revealed extreme absurdities, especially through the Sharpe ratio used to measure risk-adjusted return. While the world's best investment fund might only achieve a ratio around 1.0 to 1.5, Madoff consistently reported a staggering 2.5 to 3.0. Even more bizarre, when the dot-com crash in 2000 or the 9/11 terrorist attacks in 2001 collapsed the entire S&P 500 index, Madoff's fund calmly reported a steady profit of 1% to 1.5% every month. Probabilistically speaking, such a smooth, flawless return chart is as absurd as flipping a coin 100 times and getting heads all 100 times. The brutal truth behind that mathematical miracle was no transactions ever took place. Madoff was essentially applying a hindsight trading strategy. He used an antiquated IBM AS400 computer, patiently waiting for the market to close before looking at past price movements to print out fake statements, perfectly matching the buy low, sell high timings. More audaciously, he fully exploited a fatal structural flaw in the financial industry, the dual loophole of self-custody and phantom audits. Under strict standards, the fund manager and the custodian bank holding the assets must be completely independent. Madoff directed and acted in both roles. Furthermore, to audit a colossal $65 billion empire, he hired Freeling and Horowitz, an obscure suburban accounting firm with exactly 3 employees, consisting of 1 accountant, 1 secretary, and a semi-retired individual. It is hard to believe that the mighty Wall Street completely turned a blind eye to this glaring giant red flag. However, Madoff alone could not have extorted $65 billion. This bloodthirsty machine was fueled by silent accomplices, the feeder funds. They acted as giant straws, frantically raising capital globally to hand it directly to the boss. This is a classic testament of the willing blindness born from moral hazard when compensation structures are distorted. Take the Fairfield Century Fund, for instance. They obediently transferred 100% of their clients' money to Madoff for management, and then naturally pocketed a massive performance fee of up to 20% on the phantom profits. With hundreds of millions of dollars falling from the sky without the need for any analytical effort, Fairfield automatically turned a blind eye to all anomalies. The institutional herd effect infected the giant Santander Bank of Spain. Through its Optimal Fund, they threw $3 billion into Madoff simply because they saw American institutions investing in him, lazily entrusting their clients' financial lives to the word reputation. Throughout all those years, it wasn't that no one noticed the deception, but the impotence of the U.S. Securities and Exchange Commission inevitably enabled the crime. The agency completely failed the quantitative test due to information asymmetry. Since 2005, independent quantitative expert Harry Markopolos submitted a 21-page report detailing 29 deadly red flags. Using basic math, he proved that for Madoff to execute the option strategy as claimed, his contract volume would have to exceed the entire trading volume of the Chicago Board Options Exchange. Unfortunately, the SEC investigators, mostly lawyers with no deep understanding of financial mathematics, were blinded by Madoff's prestige. They easily accepted his self-printed statements while forgetting an introductory auditing procedure, simply picking up the phone and calling the depository trust company to verify whether that $65 billion of assets actually existed in the system. No matter how elaborately concealed, every Ponzi scheme harbors a common fatal weakness: the liquidity problem. The inflow of cash must always be greater than the outflow to sustain its life. And then the ruthless storm of 2008 struck. When the collapse of Lehman Brothers froze the global credit system, panicked investors simultaneously demanded $7 billion in withdrawals. Meanwhile, Madoff's actual account held a mere few hundred million. The fraud equation officially broke down. On December 11, 2008, Madoff was reported by his own 2 biological sons, and the FBI raided his home. The case closed with a 150-year prison sentence for the Wall Street kingpin. Madoff took his last breath in a prison cell in 2021, leaving behind a collapsed empire and tens of thousands of shattered lives. The Madoff saga concluded with a life sentence, but its brutal lesson seems to have never been remembered by the investment world. The rule that high and stable returns without risk is forever a deceitful myth. Yet greed and a weak psychological structure have continuously spawned Madoff's descendants in the 21st century. The most prime example is Sam Bankman-Fried with his FTX empire, a crypto-era version of the Madoff fraud. SBF used the exact same old psychological manipulation playbook, whopping himself in the halo effect of an MIT prodigy born to Stanford law professors and leading the effective altruism movement. This facade of erudite knowledge mesmerized the world's most formidable venture capital funds like Sequoia Capital and Temasek. Blinded by the fear of missing out, they rushed to pour billions of dollars without ever questioning the absence of an independent board of directors or a real chief financial officer, leaving SBF free to siphon customer funds to his backdoor fund Alameda Research, creating a shocking $8 billion black hole. Not stopping in the crypto sector, Silicon Valley also honored a tech scarcity fraud named Elizabeth Holmes with her company Theranos.
cleverly borrowing the image of the legendary Steve Jobs' black turtleneck to create an institutional facade. Holmes lured America's most powerful figures, like former Secretary of State Henry Kissinger, onto her board of directors to act as risk-mitigating shields. She conjured the illusion of the Edison machine, capable of running a myriad of tests from a single drop of blood, a machine that was actually completely useless, exactly like Madoff's statement printing computer years ago. Haste led giant corporations like Walgreens to obediently sign $100 million contracts without bothering to verify peer-reviewed scientific reports. Around the same time, another woman named Ruja Ignatova, self-proclaimed the crypto queen, successfully used the OneCoin multi-level marketing model to raise over $4 billion globally. Ironically, OneCoin's server system had absolutely no underlying blockchain
platform whatsoever. It was merely a simple Excel spreadsheet that automatically updated numbers daily to manipulate the working class's desire to get rich quick. Closing this chilling chronicle, we can bitterly realize a truth. Whether the setting is the streets of Wall Street in 2008, the glass and steel headquarters of Silicon Valley in 2015, or the virtual trading floors of the crypto market in 2022, the essence of financial fraud has never lain in complex algorithms or state-of-the-art machines. History will continue its cycle because the greatest danger always knows how to hide carefully behind a flawless resume, a trustworthy smile, and a crowd of financial institutions ready to turn a blind eye when the halo of profit has clouded their reason.